Your credit score is like your financial report card, and when it comes to buying a home, it can be the difference between getting the keys or getting stuck on the sidelines. I know credit scores can feel like a kind of a mystery, but today I'm going to break it down in really simple terms so you can understand it a little better. You'll learn what your credit score really means, how it impacts buying power, and some quick steps you can take if your score isn't exactly where you want it to be. So a credit score is really just a three-digit number that ranges between 300 and 850, and it tells lenders basically how risky or how safe it is to lend you money. So you can kind of think of it like a grade point average from school. The higher your score is, the more confidence that lenders have that you'll be able to pay your bills on time. Now, there are basically three big companies that monitor credit scores, and they are Experian, Equifax, and TransUnion. So they analyze numbers and then they push them out to all sorts of lenders: credit card, mortgage, car loans, student loans, sometimes even employers. So you might be wondering, why does this matter when you're buying a home? Well, there are three big reasons. The first is loan qualifications. So different type of home loans have different types of credit score requirements. For instance, FHA loans are about 580. So you have to have a credit score of at least 580 to be able to get an FHA loan. Conventional loans, they require a higher score, typically around 620 and up. And VA loans, well, they're a little bit more flexible. The second reason credit scores matters is the interest rate. The higher your score, the lower your rate, and that can really add up. For instance, here in San Mateo County, on a $1 million home, the difference between a 6.5% rate and a 7% rate could be hundreds of dollars every single month. That's thousands of dollars per year. And the third reason credit scores are important is buying power. A better credit score can literally mean you can qualify for more house with the same monthly payment. It can also open up doors to lower down payment options, so you don't have to come up with 20% for your down payment, for instance. So you're probably wondering what goes into making up that score. Well, about 35% of it has to do with your payment history and making sure that you make your payments on time. This is the single biggest factor. About 30% of the score is based on credit utilization. So it looks at things like how much of your available credit that you're using. So if you have total credit available of, say, $100,000, you wouldn't want to be using more than 30% of that total credit line. And it can vary even. It could be looked at even on individual cards or individual accounts. So if you have a $10,000 account with credit available, then you don't want to spend more than 30% of that, or about $3,000. Now, about 15% of your score is based on the length of your credit history. So the longer you have an account, the better. And if you have an account that maybe you haven't used in years and years and years, you might think twice before canceling that card, even if you're not using it, because canceling a card that has you as a customer for a long period of time, it can be advantageous for your credit score. So you want to just double check and think about that before canceling any cards. Now, about 10% of what your credit score is based on, it has to do with the mix of types of credit that you have. So do you have a car loan? Do you have a student loan? Do you have credit cards? Do you, if you already own a home, do you have a mortgage? Do you have a second mortgage? So lenders will look at all of that combined, or I guess it would be the score companies. They'll look at that all combined, and then they'll determine about 10% of your credit score based on the length or the mix of credit that you have. And the final 10% of your credit score is based on credit inquiries. So you don't want to go open up a bunch of credit cards or get a car loan right before you buy a home, or especially when you've qualified for a loan and escrow hasn't closed yet, because your credit score could drop, and at the last minute you could find that you won't be able to be qualified for the loan for your house. Now, if you're scared perfect, don't panic. There are some simple ways for you to improve it. And, it's things like always paying your bills on time. You want to pay down on credit cards as much as possible, and even a little bit can help. Hold off on opening new accounts right before you buy a house. I just mentioned that. And check your credit reports. You would be surprised how many times something will show up on a credit account that a consumer is not aware of. So you'll want to check those out regularly. As far as buying a house, here's something that you may be wondering about. You might think you need a super high score, but you don't need to have a perfect 800 score to be able to buy a home. There are all sorts of loan programs out there for all sorts of situations. Part of my job, it will be connecting you with a trusted lender who can help guide you step by step so you can find some of those options and opportunities. If you're thinking about buying, let's talk. Sometimes buyers are much closer than they realized, and the sooner you know where you stand, the sooner we can start working toward those keys. If this video was helpful, be sure and like and subscribe. I'm Jeannie Stevens, your Move Champion.